Hello everyone and welcome back to our course. Let us continue with module number 5, that is option premium anatomy. The premium you pay for an option is not random. It is made up of two components that move in predictable ways. Understanding this will transform how you think about options. Every option premium has two parts, intrinsic value and time value. Intrinsic value is the real, tangible value of an option right now. For a call option, spot price minus strike price if positive. For Nifty at 22,600 and a 22,500 call, intrinsic value equals 100 points. The option is worth at least 100 simply because it lets you buy at 22,500 when the market is at 22,600. Time value is the hope premium, what buyers pay for the possibility of further gains before expiry. An ATM option with 7 days to expiry might trade at 150 rupees total. If intrinsic value is 0, it is ATM. Then all 150 rupees is time value. Pure hope. Here is the critical insight. Time value always decays to 0 by expiry. Always. Without exception, if price stays exactly where it is, your ATM option goes from 150 to 0 by expiry. This is theta decay, covered in Module 6. This is why option buyers need a price move in their direction quickly, and why option sellers love stable markets. Every day that passes without movement, time value bleeds away and into the seller's account. Five factors that move premium. Five factors determine every option's price. Understanding each one makes you a dramatically better options trader. Factor number one, underlying price movement. This is the most obvious driver. Nifty rises. Call premium rises. Put premium falls. Nifty falls. Put rises. Call falls. The rate of change in premium per point of underlying move is called delta. We cover this in module number 6. Factor 2 is time to expiry. Every day that passes reduces time value. Theta is the daily time decay. It accelerates sharply in the final 7 days. If you are an option buyer, you are racing against time. If you are a seller, time is your ally. Factor number 3 is implied volatility. When markets become fearful before a budget, RBI policy election, IV rises and all options become more expensive. After the event, IV collapses, called IV crush, and premiums fall dramatically. This is why buying options just before an event and selling after the event is usually a losing strategy. Factor number 4 is strike price. ATM has maximum time value. Deep OTM has almost no time value. Deep ITM behaves almost like the underlying. Factor number 5 is risk-free interest rate. Rising rates slightly increase call premium and reduce put premium. Minor effect in most scenarios. Do not worry about this one. India VIX is the market's fear gauge, the thermometer of option premiums. When fear rises, India VIX rises and all Nifty option premiums becomes more expensive. India VIX below 13, low volatility regime, option premiums are cheap. Better to be an option buyer. Sellers get less income. India VIX 13 to 80, normal volatility. Both strategies, buying and selling, have their merits depending on setup. India VIX about 22, high volatility. Option premiums are expensive. Better to be an option seller or use defined risk strategies like spreads. Buyers overpay. India VIX above 30. Extreme fear. Markets in panic. Buy ATM put options for protection if you are holding equity. Or do nothing. Never sell naked options in extreme VIX spikes. The risk is enormous. Check India VIX every morning. It takes 5 seconds and tells you the entire market's risk appetite for the day. Now, the Greeks. The four forces that control every option's price moment by moment. Let us continue with module number 6. The Greeks. Delta, gamma, theta, vega. Four letters from the Greek alphabet that describe how your option's value responds to different market forces. Mastering these separates informed options traders from gamblers. The Greeks. Delta, gamma, theta, vega. Four letters from the Greek alphabet that describe how your options value responds to different market forces. Mastering these separates informed options traders from gamblers. Delta, sensitivity to price. Delta tells you how much your option premium changes for every 1 point move in the underlying. It is the most important Greek for directional traders. Delta range. Calls have delta from 0 to +1. Puts have delta from -1 to 0. Futures always have delta of +1. They move in lockstep with the underlying. ATM options have delta of approximately 0.5, meaning a 100-point Nifty move changes the ATM option premium by approximately 50 points. Practical example is you buy the Nifty 22,500 ATM call at delta 0.50. Nifty rises 100 points to 22,600. Your call premium rises by approximately 50 points, from 150 to 200. Profit of 50 multiplied by 75 equals 3,750 rupees on your 11,250 rupees investment. Not bad. But here is the leverage insight. A 23,000 OTM call might have delta of only 0.15. The same 100-point Nifty move only changes this options premium by 15 points. You paid less for it, but you also gain much less per point of Nifty movement. Delta also has a powerful second interpretation. It represents the approximate probability of the option expiring in the money. A delta of 0.50 means 50-50 chance of expiring ITM. A delta of 0.20 means approximately 20% chance. This helps you choose strike with the right probability for your strategy. Gamma, delta's accelerator. Gamma tells you how fast delta changes. It is the rate of change of delta. As Nifty moves, delta does not stay constant. Gamma controls how quickly delta shifts. Gamma is highest for ATM options and spikes dramatically near expiry. On expiry day, and ATM options gamma can be enormous, meaning even a 30-point Nifty move can change the delta from 0.30 to 0.70. The options premium can double or triple in minutes. For buyers, high gamma near expiry is your friend if you are right on direction. A small move creates an outsized gain. For sellers, high gamma near expiry is your enemy. A small adverse move can create massive losses on your shoot option position. Never hold short ATM option positions overnight when expiry is 1 to 2 days away. Gamma risk is extreme. A gap down or gap up at open can cause catastrophic losses before you can even react. The premium you collect in the final 2 days is simply not worth this risk. Theta, the time decay enemy. Theta is the daily loss in option premium due to the passage of time. Everything else remaining constant, it is the option buyer's biggest enemy and the option seller's best friend. For example, an ATM Nifty option with 7 days to expiry is trading at 200 rupees. Theta might be 15 rupees per day. If Nifty stays completely flat tomorrow, your option will be worth 185 rupees by end of the day, simply because 1 day of time has passed. Theta is not linear, it accelerates exponentially. In the final 7 days, time decay can remove 40 to 60% of remaining time value per day. An option worth 100 rupees with 7 days left might be worth 60, 35, 18, 9, 4, 1.5, and 0 on successive days, even zero price movement. Weekend effect. Markets are closed Saturday and Sunday, but theta runs 24 hours, 7 days a week. Position held Friday evening loses 3 days of theta over the weekend. By Monday open, the time value has already shrunk by 3 days even though no trading occurred. Option buyers should be very cautious about holding over weekends close to expiry. Theta as salary. Professional option sellers think of theta as their daily income. Every day the market stays stable. They earn theta from their short option positions without doing anything. This is why option selling is often described as running an insurance business, collecting premium, paying claims only when large moves occur. Vega, the volatility Greek. Vega measures how much option premium changes for a 1% change in implied volatility. It affects all options simultaneously. Calls and puts rise and fall together when IV changes. When India VIX spikes from 14 to 22 before a major event, a rise of 8 percentage points, Vega multiplied by 8 is the additional premium gain for option buyers. Even before Nifty moves significantly, put buyers profit from the VIX spike alone. IV crush. After the event, say the budget announcement, VIX falls from 22 back to 13 immediately. A 9-point IV drop. Vega multiplied by 9 is the premium loss for option buyers. Even if Nifty moved exactly as you predict, Ivy Crush can turn a winning direction call into a losing trade. The Vega rule. Buy options when IV is low. They are cheap and Vega will work in your favor as IV rises. Sell options when IV is high. Collect expensive premium and benefit when IV collapses post event. Before budget, RBI policy or election results. Never buy options the day before unless you have very high conviction and the IV is already elevated. The IV crush on the next day will destroy your premium even if you are right on direction. You now understood how options are priced. Number 7, that is option buying strategies. Option buying strategies. Long call and long put, the two fundamental directional trades with completely defined risk. Let me show you exactly how to execute each one correctly. Long call, bullish with defined risk. The long call is the simplest bullish option strategy. Buy a call option when you expect the underlying to rise significantly before expiry. Setup example, Nifty at 22,500. You are bullish. Expect a 200-point rally. Buy the 22,500 ATM call at 150. Buy the 20,500 ATM call at 150 rupees premium. Total cost 150 times 75 equals 11,250 rupees. This is your complete risk. You cannot lose more than 11,250 rupees under any scenario. Break even. Strike plus premium equals 22,500 plus 150 equals 22,650. Nifty must be above 22,650 at expiry for you to profit. Maximum gain unlimited at Nifty rises. Best case Nifty moves 300 to 400 points quickly within the first few days. Exit at 50 to 100% profit. Do not be greedy. Exit rules for long call. Exit at 50% profit. The premium doubled. Or exit at 50% loss. The premium halved. Or exit with 5 days to expiry remaining regardless of P&L to avoid accelerating theta. Never hold a long call to expiry hoping it will recover. Time is your enemy. Long put, bearish or portfolio hedge. Buy a put when you expect the underlying to fall or as insurance on your equity portfolio. Set up Nifty at 22,500. You expect a 200-point fall. Buy 22,500 ATM put at 130 premium. Total cost 9,750 rupees. Maximum loss 9,750 rupees. Break even 22,500 minus 130 equals 22,370. Nifty must fall below 22,370 at expiry for profit. Portfolio hedge use case. You hold equity worth 15 lakh rupees. You are worried about a 5 to 10% correction. Buy one Nifty put lot for approximately 9,750 rupees as insurance. If Nifty falls 10%, your put gains 12,000 to 15,000 rupees. partially offsetting the portfolio loss. Your insurance costs less than 1% of your portfolio value. This is how smart investors sleep well during volatile markets. One recommendation: every equity investor should understand long put as a hedging tool. You do not need to be a trader to use it. Once per quarter, assess if the market is at elevated level. If yes, consider buying a 3% OTM put on Nifty as portfolio insurance. Ten rules for option buyers. These 10 rules separate option buyers who make money from 89% who lose. Rule number 1: only buy when trend and momentum both agree. Weekly trend bullish for calls, bearish for puts, and RSI or MACD confirming. Rule number 2: buy ATM or one strike OTM only. Never deep OTM lottery tickets. Rule number 3: never buy with less than 7 days to expiry until it is an intraday trade. Rule number 4: exit at 50% stop loss. Always, no exceptions. Rule number 5: book 50% profit when premium doubles. Trail the remaining with stop. Rule number 6: never hold through expiry. Exit by 1 p.m. on expiry day. Rule number 7: avoid buying options 24 hours before major events. Budget, RBI, earnings, etc. Wait for the event to pass. Rule number 8: maximum 3 open option positions simultaneously. Complexity kills discipline. Rule number 9: never risk more than 5% of your FNO capital on a single trade. Entry, exit, reason, P&L, emotion, lesson. Rule number 10: journal every trade. Entry, exit, reason, P&L, emotion, and lesson. The one rule that matters the most is rule number 4. Exit at 50% stop loss every time. The traders who blow up their option buying accounts are the ones who could not bring themselves to exit a losing position. They hoped, they averaged it out. They lost everything. Exit at 50% loss and live to trade another day. Buying options gives you unlimited upside and limited Buying options gives you unlimited upside with limited risk. Selling is the other side. With module number 8, let us start. Option selling strategies. Selling options is statistically favorable. 65 to 70% of options expire worthless, but the risk is asymmetric. Discipline here is not optional. Let me show you how professionals approach it. Why sell options? Option sellers benefit from two powerful forces: theta decay and probability. Every day that passes without the market moving significantly, time value bleeds from option buyers to option sellers. Sellers receive this daily income passively. Statistically, 65 to 70% of options expire worthless. The seller pockets the full premium in those cases. This is why option selling is often compared to running an insurance business. You collect premiums regularly and occasionally pay a claim on extreme events. But here is the critical asymmetry. An option seller's maximum gain is the premium collected. An option seller's maximum loss is theoretically unlimited for naked positions. One unexpected event, a surprise RBI decision, a global market crash, a geopolitical shock, can cause a loss 10 to 30 times the premium you collected. Discipline, stop losses, and defined risk structures are not optional, they are survival requirements. Never sell naked options as a beginner. Start with covered calls, where you own the underlying, or with defined risk spreads. Naked selling requires significant experience and capital. Covered call. The covered call is the safest option selling strategy and one of the most popular income strategies globally. You sell a call option on a stock of ETF that you already own. The shares you hold cover your obligation, hence covered. For example, you own 75 units of Nifty ETF at 220 rupees each. Total value 16,500 rupees. Nifty is at 22,000. You sell the 22,500 CE, a slightly OTM call, at 50 rupees premium. You collect 50 multiplied by 75 equals 3,750 rupees immediately. This cash is in your account right now. 3 scenarios at expiry. If Nifty stays below 22,500, the call expires worthless. You keep the full 3,750 rupees premium and still own your ETF. Your ETF cost has effectively been reduced. If Nifty rises above 22,500, your ETF gains, but you are obligated to sell at 22,500. If Nifty falls sharply, the call expires worthless. You keep the premium, but your ETF value falls. The premium gives you 3,750 rupee cushion against the decline. Covered calls are ideal for investors who hold equity and want to generate monthly income from their portfolio without selling. Selling one ATM call per month on your equity holding can add 1 to 2% monthly income on that position. Option selling rules. 6 non-negotiable rules for option sellers. Rule number 1. Always set a stop loss at 2 to 3 times the premium received. If you sold at 100, your stop is 200 to 300. Enter this as an actual order, not a mental note. Rule number 2. Sell OTM options with delta 0.15 to 0.25, approximately 15 to 25 times probability of going ITM. This is the sweet spot of premium versus risk. Rule number 3. Prefer defined risk strategies. Iron condor, bull put spread over naked selling. Defined risk means your maximum loss is capped. Rule number 4. Exit when 50% of maximum profit is captured. Do not wait for the full premium to expire. Re-enter on a new trade. Rule number 5. Never sell options in the week of major events like budget, RBI policy, election results. IV can spike unpredictably and premiums can multiply 5 to 10 times against you in hours. Rule number 6. Never sell ATM options 1 to 2 days before expiry for the residual premium. Gamma risk at that point is extreme. A 0.5% market move can cause 200 to 300% loss on the position. The remaining premium simply does not justify the risk. We will look at more sophisticated strategies that combine buying and selling in module number 9, that is, multi-legged strategies. Now, let us look at more sophisticated strategies that combine buying and selling in module number 9, that is, multi-leg strategies. Bull call spread, straddle, iron condor. These combine multiple options to create defined risk reward profiles for specific market views. Let me walk through the three most important ones. Bull call spread. A bull call spread combines buying a lower strike call and selling a higher strike call. The sold call reduces your cost and caps your maximum profit. For example, Nifty at 22,500, buy 22,500 CE at 150, sell 22,800 CE at 70. Net premium paid equals 150 minus 70 equals 80 per unit. Total cost equals 80 times 75 equals 6,000 rupees. Compare this to a long call which costs 11,250 for the same bullish view. Maximum loss 6,000 rupees. The net premium paid. Break even 22,500 plus 80 equals 22,580. Maximum profit 22,800 minus 22,500 minus 80 equals 220 points times 75 equals 16,500 rupees. Risk reward. Risk 6,000 to potentially make 16,500 at 1:2.75 ratio. Use a bull call spread when you are moderately bullish. You expect a 1 to 2% move but not a massive rally. It cuts your premium cost in half compared to a long call while maintaining excellent risk rewards. Straddle, an iron condor. Long straddle. Buy both an ATM call and an ATM put at the same strike and expiry. You profit if Nifty makes a large move in either direction. For example, buy 22,500 CE at 150 and 22,500 PE at 130. Total cost 280 points times 75 equals 21,000 rupees. Upside break even 22,780. Downside break even 22,220. Nifty must move beyond these levels for profit. Best use for straddle. Before major events like budget and election results, when you expect a big move but do not know the direction, buy the straddle when IV is low. 1 to 2 weeks before the event. As the event approaches and IV rises, the straddle gains value from IV expansion even before Nifty moves. Iron Condor. Sell an OTM call spread and an OTM put spread simultaneously. You collect premium from both sides and profit if Nifty stays within a defined range at expiry. For example, sell 23,000 CE, buy 23,200 CE and sell 22,000 PE. by 21,800 PE. Net premium collected approximately 85 points. Total profit if Nifty stays between 22,000 and 23,000. 85 times equals 6,375 rupees. Maximum loss 8,625 rupees if Nifty breaks either boundary. Iron Condor is the most popular strategy for weekly Nifty options. Sell Monday, buy back Thursday morning at 50 to 70% profit. Works beautifully in low volatility, range bound weeks. Fails on trend days or sudden gap moves. Now, a dedicated focus on India's most traded instrument, that is Nifty and Bank Nifty index options. We will learn about this in the next module, that is module number 10, index options. I would request all the viewers to please subscribe to stay updated with latest educational videos and visit fintamin.in for more insightful knowledge on stock markets and financial planning. See you in the next part.